Gentlemen,
Morning.
how are we?
Good morning, we're back.
Yeah, we are back. It's January.
Go figure. First one of 2025.
I know, yeah. And first January, first month, coming off an election, coming off of a lot of news. You know, we had a couple pods there in December, you know, just to kind of catch everyone up. So we had a lot of changes going on, but that doesn't mean it doesn't stop changing.
Yeah.
Just because you turn the calendar.
Right. So was it changing, or was it just media headlines coming hard and fast, and we had to keep up with it because we never want you to be without information?
I'm going to go with that one.
There you go. That's a big reason why we do this and stay committed to it. So, well, let's jump into it. You know, coming off the close of 2024, we saw some weakness.
Right.
I think a lot of that was more structural. We kind of talked about that. And lo and behold, look at that. January, that next month, eroded away all of that weakness. The S&P 500, top 500 companies in the U.S., had a very positive month, 2.78% to the upside. So that was good. And bonds were not left behind either. You know, bonds yet again had a choppy December, but we saw the aggregate bond index appreciate by 0.53% in the month of January 2025. So that was good. And it's kind of that reflexive bounce back. But there's a lot going on.
Right. There
There's
really
a lot
is.
going
There
on
really is.
that we need to stay focused.
You know, we kind of go through these different topics, you know, and kind of jumping off with the market. It's really where we kind of start. But I think if we kind of go to that next layer and look at the portfolio and changes maybe that we made after the election, after the inauguration, like those kind of steps, you know, like what did it look like? What did we do?
Yeah, definitely. So think about the market as the roadway, and then the investment vehicles in your portfolio as the vehicles. And the vehicles are going to take us to our destination. But we have to be prudently paying attention to, like, what are we going to go through to get to that destination? It's going to be winter driving conditions like we have here in Michigan. Well, we probably need something with four-wheel drive. I guess where I'm going with this is the environment changes for those right investments within a portfolio. And our job is to anticipate and act.
Right.
So one of the things that you saw us do as we saw the election results, right? We made some changes, and that was, again, a couple months back. But when you're talking about, like, what are we doing in the portfolios? Well, we've already made some changes that are manifesting in a positive way so far. So you might have remember us bringing up the fact that we bought some dividend-paying stocks. Well, think about that. A company that's paying a dividend is essentially returning, you know, equity to shareholders on some interval. Well, imagine if the dollar is weakening, right? And somebody is proposing, think about it. Remember, when you own a stock, you own a business. The business owner says, you're that, but the one managing it says, here, I want to give you some of the profit in a dividend. If the dollar is falling off a cliff, you're going to go, no, go ahead and put that back in real estate. You know, maybe there's some R&D or something like that. So that's what we've been dealing with for a long time. But remember, the thoughts of tariffs would embolden and strengthen the dollar. So now think of the same trade-off. You go to pay an investor a dividend and the dollar's appreciating. Hey, thank you very much. When's the next one? So you can utilize that vision forward and try to hook up to those high probability risks that we could put in a portfolio. Another one, when you think about the idea of tariffs, it kind of is this mercantilism. It's like a mercantilistic approach, focusing inward. You know, rather than trade liberalization and more trade, you know, you're focusing inward on your economy. Well, think about companies that are very large, mega caps, large caps. They almost have to do business outside of our borders just because of their size. What about those small and medium-sized companies here in the U.S. that are truly the heartbeat of the American economy? Now, you have to be careful because small and medium-sized businesses can, you know, lose money. There's a lot more ups and downs in them. But we can screen those out and put that to work in a portfolio with this idea that we're trying to get the boom to happen within our borders. So I guess I just take a moment to highlight the fact that we're doing this for you.
Yeah, already on top of it, right?
Yeah, so there you go. That's a bit of a portfolio update.
Yeah. And, you know, you brought up kind of one of the big words, which is tariff, right? And you mentioned, you just touched on like the dollar and how it might affect it. Does it go stronger, weaker? Why are we doing it? We have a few of those kind of tariff topics, but I guess let's just start right off the top with how does it affect the dollar, or how does it affect kind of that top line?
The amount of times I've heard the word tariff in the last few months. We could do the entire year's worth of podcasts
gonna
on
say,
that.
right?
So, you might even be exhausted with it, but here we go. So yeah, a lot of talk about tariffs, and my undergrad's in economics. Again, I could take us through many layers to what a tariff is and what it needs to, what you need to be thinking about. But look, you've got us here for this. So really, what is a tariff, and what should you be thinking about? Recognize that a tariff it's not as simple as just saying tariff, because it can come in many different forms and fashions. So where do we want to start?
Yeah. I mean, we were looking at, how will it affect the dollar?
There you go.
Because you're
Okay.
talking about the
Let's
changes
jump right
of the
in there.
portfolio. Yeah.
Well, we've got a few, right? So we've got a few subtopics to go off. So where do we start? Let's talk about that. Think about this. A tariff is an entry barrier. It's an entry barrier that can be discretionary, and it would be imposed by a government, okay? So what you're doing is creating an entry barrier to an economy. That's what it is on balance,
Right.
okay? And everybody's always worried that, well, my gosh, if all of a sudden something costs more because there's a cost to come into our economy, that cost is going to be passed off to the consumer. There is an element of that, but it's not that simple. It's not that simple. You'll find pocketing of maybe those inflation impulses, but one of the things that happens with tariffs is you tend to see the currency strengthen of the country that puts them in place. And why is that? Well, think of, and again, this is just a very simple generalization, but the bottom line is a country's currency is like the stock price for their economy. So when you think about why do stock prices go up? Typically it's because there's something of value there that can be driven by scarcity. So for instance, if there's 100 shares of a company out there and that company is doing really well, you want to go buy one of those 100 shares, and you're probably willing to pay up for it because there's only 100 out there, right? Well, what if they cut that down to 10? They cut their float to 10. You might scramble even harder because there's less of them, hence the short squeeze impulse and what have you. So I say this, when you create an entry barrier, all of a sudden there's more value to having access to the U.S. economy, so the currency tends to go up. So even if something costs more, you're going to have more purchasing power to pay for it.
With that dollar.
Right. So oftentimes that's overlooked. So look at that dollar strength and then think about it as it fights the inflation that would come along with those tariffs. So it's not as simple as a media headline might make it seem.
Speaking to that, this isn't the first time that we've seen Donald Trump as president. Hearing these, tariff talks, kind of echoing that America First policy, right? We saw that, more than 4 years ago, and we're seeing it again now. Is this just part of the art of the deal?
Yeah. Well, he did write that book.
Yeah.
So yeah, I think so. There's been a number of ways that you can impose tariffs. Obviously, anybody who's not living under a rock is probably continuing to hear, well, it's this with this country or this with this block of countries. Right. They truly, these tariffs, and this isn't the first that we've seen Trump use them, they are part of deal making.
Yeah.
And I was just curious, and I went back and looked at, and this is a crude exploration into this strategy, but had you bought the market volatility that coincided with the headline of tariffs back under his first presidency, you'd be looking pretty good. Yet again, what does that mean? It just kind of means that they're probably being dangled more as like motivations, or trying to prohibit some action or activity. So perhaps that gives us some opportunities.
Yeah.
Well, that's kind of where I was going with that. Volatility can create opportunities both ways, right? And so, how are we looking at opportunities, knowing from the research that we've done, talking through that in the water cooler talk, but what are we looking at from an opportunity perspective from these tariffs to benefit clients?
Yeah. So that's a great question. We've talked a lot about that. And I think that this isn't a surprise because the campaign trail, it was full of the word tariff. So again, this isn't much of a surprise. So at the top of the pod, we talked about some of the movements we made in portfolios. Bingo, there you go. There's your opportunity. We just talked about art of the deal. Perhaps if you go back and back test the strategy of buying that headline and that volatility, it was probably pretty good. So as we think about navigating a portfolio around, we will use these potential air pockets driven by the headline risk of tariffs. But you kind of get a feel for what we're going after. These things can create opportunities. Right on down to it all flows through to this big picture on, involving Scott Bessent, Treasury Secretary, and looking at the finances of the nation and what might it allow for. So here's food for thought, and we haven't really touched on this yet, but if you do get these established tariffs, and they are there to stay, it may very well provide some cover for the Fed to lower interest rates.
Right.
And that would then theoretically go hit more your average American household who's trying to get a new car and maybe get a house.
Yeah.
Home ownership has been tough here over the last decade. Yeah. So those tariffs might provide some cover for that. What would that then lead to? Well, maybe bonds will start to have a little day in the shade, but a little bit too early to see there.
A little more consistency maybe from that side of it.
Well, and I think there's still, those are kind of some of the things to maybe, give yourself a little bit of ease. But, I know we're still receiving phone calls, and maybe they've kind of died down a little bit. But, again, we've heard the tariffs, and it's freaking some clients out and say, what are we doing to kind of protect? What kind of safeguards, do we maybe have, or systems do we have in place if there is extreme volatility, or if these tariffs do ratchet up? I know we've got some extensions out there right now, but let's just say that this stuff does end up escalating into a trade war where we've got more global escalation. What are we doing on our end to make sure we've got these things in place to protect our clients?
Sure. Well, what you're driving towards, Derek, I think, is confidence in your advisor.
Yeah.
Right?
Yeah.
I hate to let the cat out of the bag here, but a lot of the value that we provide is just controlling those emotional responses. And I'm not kidding.
Yeah.
There's been plenty of studies done.
Right.
One of the greatest impacts that an advisor can make in their client's life is really not allowing these emotional decisions to manifest within the business plan. Remember we talked about this portfolio is your business, and it can work for you. We just got to do it smart. So how do you get the confidence in your advisor? Well, there's a lot of different ways. I think one of those ways is understanding that they have a plan. They have a consistent, repeatable system, and they have the competence to run it, and then the discipline to stay committed to it. And then I don't care what the headline is.
Right.
We are able to make movements that serve our client bases. And one of those would be, who are we talking about? Retiree. Well, if things get really challenging, it's not like we just assume that bonds are going to always hold up through that market volatility. Quite frankly, when you really need those bonds to hold up, historically speaking, they've kind of sold off in unison with stocks. So maybe we need to understand that has played out over the last 20 years and recognize the need for stability in something that's more cash-like.
Yeah.
Money market rates are still great.
Right.
So how about this one for perspective? Retiree taking money, you start to see deterioration to a degree we're concerned about. We start to see trend lines broken. We start to see volatility in the near term really spool up. Maybe some warnings from corporate America. I mean, this is starting to get into a position where now we need to build some defense. So for that retiree who's maybe got a monthly distribution coming out, well, we could raise 1 year's worth of withdrawals, park it in a money market-like vehicle, and guess what? You've got a whole year to not have to sell anything.
Right.
Get a little bit more downside, maybe we're adding 3 to 6 months more on top of that, but then you have a whole year, and guess what? Every market downturn to date has had a recovery.
Right.
It's just how long does it take to get there, right?
So let's buy ourselves some time.
That's right.
Certainly continue to stay diligent and on top of things. But again, we need to buy time. So that's just one of those kind of systems that we would use to protect our clients.
Right. Time in the market versus timing the market.
And time and communication with clients, right?
Oh, yeah.
Like the longer that we can, talk with you, work with you, we try to build that trust and confidence over time. So.
It's not really easy to sit in this position and totally restrict and arrest all of your emotional responses But that's what we have to do. And there's a lot of years of experience sitting right here. It's what we do.
Yeah.
Yep.
And, kind of adding to that confidence, right, is making sure that we're looking at all those different areas that could add value or add dimensions, how you're evaluating portfolios, investments, the markets, the economies. And I guess, with President Trump coming in, with social media, with everything that's going on, maybe it's not just the Fed notes anymore that we try to read as tea leaves, right?
It's so funny because here we are again. It doesn't matter what advanced degrees you have. You need to have what was a Twitter, now X account
Right.
to see what the president's going to tweet.
Right.
It'll blow any chart out of the water. It'll blow any fundamental research you've done out of the water. So you bring up a great point. It's kind of like, there's an element of adaptation that we have to have to serve our clients properly. What do you have to do? Well, now you got to subscribe to these tweets because the minute they come out, they move the market.
Yeah.
We don't have any other leaders like that, quite frankly, at least in the government. So it is what it is, and take however you feel about that. It doesn't matter. We need to be on top of that. So you bring up a great point. It's always changing. I was just talking to one of our younger colleagues earlier this morning, and I said, well, now I've got this service to provide me with those data points. So remember to tell somebody that. Well, I used to have an Excel spreadsheet, get the data, put it in the next morning. Now, it's like a data feed that I get. It's pretty nice, but it was an innovation and a change. Well, I don't know how innovative this is, but now we got to watch these, different communications.
We'll continue to adapt. All those years of service you mentioned, all those years of doing this, we've had to adapt, right? So whether it's Excel sheets or social media, what did he say? What was that?
And it's almost daily, right? It's what did he say? When we're still sleeping, sometimes even. It's what are we waking up to?
Oh, that was Doncic, right?
That's right. That's right.
Yeah. No, but look it's the guerrilla warfare in the trenches, some hand-to-hand combat. You've got to just understand what it is. We're in here for you.
Right.
We're in here for you. We're going to do whatever it takes to try to continue to keep that edge and never let them pull it from us.
Well, so let's look ahead then, right? So we kind of got into tariffs, some other things, but looking into towards the end of this quarter, maybe even the next month or two with the Fed and some of the other things that are coming on. What can we look at? What should we be looking at? What are we looking at? Did we look at for them?
So what you have is a paradigm change to a degree. So what's happening is you're getting everything that was done a certain way is changing. So it's kind of like really looking at, okay, what is it changing for? How is it changing? And then the key is like how much liquidity is continuing within either system, because liquidity is the lifeblood to the economy, which then is the lifeblood to the markets. So if the liquidity remains intact, we're good.
Yeah.
Here's the thing. The transition from doing it this way to now doing it this way is bumpy. And you can't get everything out at once. Things take time to manifest. But everything that I've seen so far hasn't been a tremendous drain on liquidity. But it doesn't mean you're not going to see bumps along the way as we do the phase transition. Mm-hmm. But that's really what we're watching for. And usually the market can sniff it out pretty good. Yeah. But like we talked about, be prepared for volatility on the front end of this year. We've already seen it. Mm-hmm. We've already seen it. And that should kind of continue. But once we're here and everyone can kind of recognize that that liquidity is in place, it's just maybe in different places, then you can start to feel a little bit better about the drumbeat of market movement.
Right. Well, hey, we'll stay on it. We'll be with you next month. Thank you for joining. Always enjoy the conversation. Hopefully you enjoy it, and we'll talk to you soon.
All right.
Advanced Capital Management Incorporated is a registered investment advisor. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor before implementing any strategy discussed herein. Tax and estate planning information should not be construed as formal legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation. Thank you, and we look forward to seeing you next month.